If you're thinking about investing in Zynga, let me tell you right now, do not do it. Stay far, far away from Zynga. The social gaming company, which went public late last year, was supposed to be the savior of the IPO market last year. It was supposed to be the huge hit. But when it went off at $10 a share and the stock slumped, it quickly became clear that those investors in the know knew all too well that Zynga really wasn't a good company to invest in. But why? See, Zynga suffers from a host of issues, namely that it relies so heavily upon Facebook that if any breakdown in the relationship between the two companies happens, the company's stock is going to plummet. I mean, did you know that Zynga right now generates about 90%, if not more, of its revenue from Facebook? And its accounts receivable at last year was about 86% made up of Facebook. Not to mention, the company has signed a multi-year agreement with Facebook to use its credits virtual currency, making it, well, locked to Facebook for the next several years. Now, Facebook right now says, I think we're okay with Zynga. The company has its Farmville, Cityville, and countless other games that we're making a lot of money on, and for now, we'll be fine. But who knows what Facebook will do next? Will it get into online gaming? Will it get into online gambling like Zynga wants to do? What will it do? We don't know. But we also need to consider that the company's chief executive, Mark Pincus, is not necessarily saying the right things to investors. In a recent interview earlier this month, he said, look, we got what we wanted out of the IPO. We got our $1 billion. Now we're going to be able to do what we want with the cash when we want. He's not necessarily concerned about the short-term profit opportunities for shareholders. That's not a thing that shareholders like to hear, and it's certainly not a thing that future investors want to hear. They want to hear that their CEO wants to maximize their stock value. They want to hear that he has a real plan for growth that will see the stock price gain. But the problem is, Zynga's stock price is probably not going to gain much. The company is probably best valued around $7 or $8 a share, if you listen to many analysts, and, well, I don't think there's much arguing that. Zynga is not a company you want to invest in. The web is great, online startups are there, but if you really want to make some cash, I mean, Zynga's not where you want to be. Google? Maybe. Yahoo even maybe. If the company can start selling off parts of his business, then maybe the stock will rise. But Zynga, no. It's a mistake. And make sure you realize that.